Has been a slight move thus far after a big day. You can see right now it is red across the board, but it was a strong rally on Wall Street today. Investors seem to be hopeful about some positive signs that we are starting to see relative to the virus right now. You can see what's taking place throughout the day today. It was a very strong rally on Wall Street. Positive signs about the outbreak. The Dow rallying nearly 780 points, closing back above 23,000 for the first time in nearly a month. The S&P 500 rising 3.5%, and the Nasdaq 2.5%. So with today's moves, all three indexes have rallied sharply now from their March 23rd lows. The Dow is up 28% since then. The S&P 500 up 25%, and the Nasdaq is 22% from its low. Let's bring in now Lizanne Sonders. She's the Chief Investment Strategist and Senior Vice President with Charles Schwab. Lizanne, welcome back. It's good to see you. We've erased a lot of damage, as we said, from the lows. Right. Can we trust it?
I think it's a little too soon to say. We all know that we're rewriting the playbook here, so we have to take with a grain of salt what history says. I mean, in a normal bottoming process, more often than not, you see a relatively weak breath rally off the lows. This one was particularly sharp over a condensed period of time, of course. And typically when you don't have strong breath, which we've not really had, more often than not, you have a retest. And then the final move from the low is on, multiple breath thrusts. So, but again, the virus is really dictating the story. We saw a massive reversal yesterday when the CDC came out with slightly worse than expected daily numbers. And I think we're still going to be at the mercy of the news in both directions.
As long as the virus news doesn't get worse, does that necessarily mean that we might not test the lows?
Well, I think the next step, of course, is how and when we start opening back up the economy and what the recovery looks like. And that's still ahead of us. That's not behind us. So I think we all, rightly so, have had a consensus view that you would need to see a bending of the curve to start to build some of that confidence. But, of course, the next big step is what the contraction in the economy looks like and how quickly across the spectrum of industries and sectors we can see recovery. The other thing that we need to be mindful of with this sharp rally off the lows is it's been driven by the most beaten up sectors. I'm not sure that's a message of strength looking ahead for the economy when it's energy and REITs and some of the areas that just got absolutely slammed. So right now it looks more like just some bottom fishing, but the reality is I have no idea.
So what are you suggesting that longer-term investors do this evening who are listening to our conversation?
Well, what we've been suggesting really all along, we've been pounding the table in the last year about going back to the tried and true discipline around rebalancing, making sure you have a plan, you're diversified across asset classes, but rebalancing maybe a bit more frequently. And in particular in the last year, saying a lot of people rebalance with some sort of calendar periodicity. They might do it on a quarterly basis or an annual basis. In this environment, given volatility, you want your portfolio to dictate the timing of rebalancing, where you get extreme moves both on the upside and the downside. And it gives you opportunity to sort of stay just on the right side of the trade, for lack of a better word. We just really want to reinforce that to be a successful long-term investor does not require you pinpoint tops and bottoms. Investing should be a process over time, never about a moment in time. And I think there's never a bad time to remind investors of that.
Do you think the leaders of the past will be the leaders of the future in terms of the big momentum, high-tech names, the Microsofts, the Facebooks, the Amazons, the Apples, the Googles?
Well, keep in mind that along with that leadership into the February highs, you had the strange bedfellow of utilities alongside the technology names. So you had this sort of dual momentum act going on in the market with the traditional momentum in many of those high-cap tech names, which I think represent quality totally different than, say, the 1999, early 2000 period. So, yes, I think they will continue to be dominant players. But you also had that strange bedfellow of utilities, which I think has been a function of the yield grab in a very yield-starved world. So we could see a partnership based on investors' need for income representing strength in areas like utilities, more recently in REITs. But I do think some of those high-quality growth names, particularly given that valuations have come down, not that we can trust the E yet, probably still make sense. So I think to some degree you're going to see a reemergence in some of those same kind of odd leadership pairs.